When evaluating investment opportunities for 2025, comparing gold and the Nifty 50 index is not just a matter of preference. It is a strategic decision rooted in macroeconomic conditions, market behavior, and individual financial goals. Gold, as a tangible asset with thousands of years of intrinsic value, operates as a global safe haven during periods of uncertainty, inflation, or geopolitical instability. In contrast, the Nifty 50 represents the top 50 companies listed on India's national stock exchange, offering exposure to the country's most dynamic and profitable sectors including banking, information technology, energy, and consumer goods. Choosing between them requires understanding not only their historical performance but also how global and domestic forces will shape their trajectories over the next 12 to 18 months. Investors must weigh gold's role as a store of value against the Nifty's potential for capital appreciation through corporate earnings growth, dividend yields, and economic expansion. While gold does not generate income, it preserves purchasing power. While the Nifty does not offer physical security, it compounds wealth through market participation. Neither asset is universally superior. Their effectiveness depends entirely on the investor's time horizon, risk tolerance, and the prevailing economic environment. In 2025, three major factors will dominate this comparison: inflation trends, interest rate decisions by central banks, especially the United States Federal Reserve and the Reserve Bank of India, and the pace of India's gross domestic product growth relative to global slowdowns. These variables will determine whether capital flows toward defensive assets like gold or risk-on assets like equities. Therefore, the first step in making an informed decision is to strip away emotional bias and examine each asset through the lens of data, structure, and forward-looking indicators, not past performance alone. Gold's fundamental appeal lies in its scarcity, universal acceptance, and independence from any single government or financial system. Unlike fiat currencies or equity indices, gold cannot be printed, defaulted on, or diluted through corporate actions. This makes it uniquely resilient during systemic crises, whether those stem from banking collapses, currency devaluations, or sovereign debt defaults. In 2025, if inflation remains stubbornly above central bank targets, particularly in developed economies, gold is likely to outperform financial assets as investors seek real returns uncorrelated to monetary policy failures. Additionally, geopolitical tensions, such as prolonged conflicts in Eastern Europe, instability in the Middle East, or United States-China trade friction, historically trigger capital flight into gold, pushing prices higher regardless of equity market performance. Gold also benefits from negative real interest rates. When the nominal yield on bonds falls below the inflation rate, holding non-yielding assets like gold becomes more attractive. India, as one of the world's largest physical gold consumers, adds another layer. Domestic demand for jewelry, coins, and bars often surges during festivals and wedding seasons, creating seasonal price support. However, gold's weakness is its lack of cash flow. It does not pay dividends, generate profits, or benefit from productivity gains. Its price is driven almost entirely by sentiment, monetary conditions, and supply-demand imbalances in physical markets. For long-term investors seeking compounding growth, this is a critical limitation. Gold should therefore be viewed not as a growth engine but as a portfolio stabilizer, a hedge against tail risks that could derail equity-heavy allocations. In 2025, allocating 5% to 15% of a diversified portfolio to gold may be prudent, depending on global volatility levels and the strength of alternative safe haven assets like United States Treasuries or the Swiss franc. The Nifty 50, on the other hand, represents ownership in India's most influential publicly traded companies, a proxy for the nation's economic engine. Investing in the Nifty means participating in India's structural growth story: rising middle-class consumption, digital transformation, infrastructure expansion, and increasing corporate profitability. Unlike gold, the Nifty generates returns through multiple channels: capital appreciation driven by earnings growth, dividend payouts from mature companies, and sectoral rotation based on policy reforms or global demand shifts. In 2025, India's gross domestic product is projected to grow between 6% and 7%, outpacing most major economies, which creates a favorable backdrop for corporate revenue expansion and margin improvement. Sectors like financial services, information technology, and renewable energy are expected to lead this growth, supported by government initiatives such as production-linked incentives, digital public infrastructure, and green energy transition policies. Additionally, foreign institutional investment inflows into Indian equities have remained robust despite global headwinds, signaling strong international confidence in India's macroeconomic stability and reform trajectory. The Nifty's price-to-earnings ratio, while elevated compared to historical averages, remains justified if earnings growth materializes as forecasted, meaning valuation alone should not deter long-term investors. However, the index is not without risks. It remains sensitive to global liquidity conditions, United States interest rate movements, rupee volatility, and domestic political uncertainty around elections or regulatory changes. A sudden spike in crude oil prices or a slowdown in global tech demand could disproportionately impact key Nifty constituents. Therefore, investing in the Nifty requires not just optimism about India's future, but also disciplined risk management, including dollar-cost averaging, sector diversification within the index, and periodic rebalancing to avoid overexposure during euphoric market phases. One of the most critical differentiators between gold and the Nifty in 2025 will be their correlation or lack thereof with global financial markets. Gold typically exhibits low or negative correlation with equities, especially during periods of market stress. When stock markets crash due to recession fears, credit events, or liquidity crunches, gold often rallies as investors liquidate risk assets and rotate into hard assets. This inverse relationship makes gold an effective diversifier within a multi-asset portfolio. The Nifty, by contrast, is highly correlated with global equity markets, particularly United States indices like the S&P 500, due to interconnected capital flows, multinational earnings exposure, and synchronized monetary policies. If the United States enters a recession in 2025, triggering a global risk-off environment, the Nifty is likely to decline alongside other emerging and developed markets, regardless of India's domestic fundamentals. This does not mean the Nifty lacks resilience. India's relatively closed capital account and strong domestic consumption base provide some insulation, but it does mean investors cannot rely on the index as a hedge during global downturns. Gold, in that scenario, becomes the portfolio's shock absorber. However, during periods of synchronized global growth, such as a soft landing after rate hikes or a rebound in tech and manufacturing demand, the Nifty can significantly outperform gold, delivering double-digit annualized returns while gold stagnates or declines in real terms. Therefore, the decision between the two should not be framed as either or, but as how much of each, depending on the investor's assessment of global macro conditions heading into 2025. A balanced allocation, for example, 70% Nifty and 30% gold, may offer both growth potential and downside protection, especially in an uncertain macro environment. Another dimension to consider is liquidity and accessibility. Both gold and the Nifty offer multiple entry points for retail and institutional investors, but their mechanisms differ significantly. Gold can be purchased physically, as bars or coins, through sovereign gold bonds, gold exchange-traded funds, or digital gold platforms, each with varying levels of storage cost, purity assurance, and tax treatment. Physical gold carries risks of theft, impurity, and resale friction, while sovereign gold bonds and exchange-traded funds offer paper exposure with government or exchange backing, lower costs, and easier exit options. The Nifty, meanwhile, is accessible through index funds, exchange-traded funds, futures contracts, or direct stock purchases replicating the index weightage. Nifty exchange-traded funds, in particular, offer intraday liquidity, low expense ratios, and automatic rebalancing, making them ideal for passive, long-term investors. From a taxation standpoint, both assets have distinct implications in India. Long-term capital gains on gold, held over 3 years, are taxed at 20% with indexation benefit, while equity-oriented Nifty funds enjoy 10% long-term capital gains tax above 1 lakh rupees, with no indexation. Short-term gains are taxed as per income slab for both, but equity enjoys a lower short-term capital gains rate of 15%. Transaction costs also vary. Gold exchange-traded funds and sovereign gold bonds have minimal fees, while actively managed Nifty funds may carry higher expense ratios. Additionally, gold requires no demat account or brokerage, whereas Nifty investments typically do. For investors prioritizing ease of entry, low maintenance, and regulatory simplicity, Nifty exchange-traded funds currently offer a more streamlined experience. For those seeking tangible ownership or distrustful of financial intermediaries, physical gold or sovereign gold bonds may be preferable, despite their operational complexities. In 2025, technological advancements in digital gold and fractional Nifty investing will likely narrow these gaps further, but structural differences in taxation and settlement will persist. Currency risk is another underappreciated factor when comparing gold and the Nifty. Gold is globally priced in United States dollars, meaning its rupee-denominated return for Indian investors depends not only on the dollar price of gold, but also on the US dollar to Indian rupee exchange rate. If the rupee depreciates against the dollar in 2025 due to trade deficits, capital outflows, or Federal Reserve rate hikes, gold becomes more expensive in rupee terms, boosting returns for domestic holders even if global gold prices remain flat. Conversely, if the rupee strengthens, gold's local return may lag despite global gains. The Nifty, being a domestic index, is insulated from direct currency fluctuations. Its performance is measured in rupees, and its constituents earn primarily in local currency, though export-oriented companies like information technology firms are indirectly affected by forex movements. However, a weakening rupee can attract foreign capital into Indian equities as dollar-denominated returns become more attractive, creating upward pressure on the Nifty. So while gold's rupee return is doubly exposed to global gold prices and forex swings, the Nifty benefits indirectly from rupee depreciation through increased foreign inflows. This dynamic creates an asymmetric currency hedge. Gold protects against rupee depreciation directly, while the Nifty may benefit from it indirectly via capital flows. For investors with significant dollar liabilities or overseas expenses, gold's dual sensitivity may be advantageous. For those focused purely on rupee-based wealth creation, the Nifty's insulation from forex volatility may be preferable. In 2025, with the Reserve Bank of India likely to manage the rupee within a controlled band and the Federal Reserve potentially cutting rates, currency movements may moderate, but they remain a decisive variable in total return calculations for both assets. Behavioral and psychological factors also play a crucial, though often overlooked, role in the gold versus Nifty decision. Gold appeals to investors' instinct for safety, tangibility, and tradition. Many Indian households view gold not just as an investment but as a cultural asset, passed through generations, used in ceremonies, and trusted during crises. This emotional connection can lead to irrational allocation, overinvesting in gold during bull markets or holding it indefinitely without rebalancing. The Nifty, being an abstract financial instrument, lacks this emotional anchor, which can be both a strength and a weakness. On one hand, it encourages disciplined, data-driven investing. On the other, it can trigger panic selling during corrections or fear of missing out buying during rallies. Behavioral finance research shows that investors consistently underperform indices due to timing errors, buying high and selling low, and this risk is higher in volatile assets like the Nifty than in stable ones like gold. However, gold's low volatility can also breed complacency. Investors may hold it for decades without reviewing its role in the portfolio, missing opportunities to reallocate during equity bear markets. In 2025, investors must consciously separate emotional bias from strategic allocation. Gold should not be held because it's always been safe, but because current macro conditions justify its hedge function. The Nifty should not be avoided because markets are too risky, but evaluated based on earnings visibility, valuation spreads, and India's growth differential. Tools like systematic investment plans for Nifty exchange-traded funds and staggered gold accumulation through sovereign gold bond tranches can help mitigate behavioral pitfalls. Ultimately, the best-performing portfolio is not the one with the highest returning asset. It is the one the investor can stick with through market cycles without emotional interference. So, which is the better investment in 2025, gold or the Nifty? The answer is neither and both. Gold is not a substitute for equities. It is a complement. The Nifty is not a speculative gamble. It is a participation in India's economic ascent. For aggressive investors with a 5 to 10-year horizon and high risk tolerance, a 70 to 80% allocation to Nifty via low-cost exchange-traded funds or index funds, combined with 10 to 20% in gold, preferably through sovereign gold bonds for tax efficiency and yield, offers optimal growth with controlled volatility. For conservative investors nearing retirement or prioritizing capital preservation, a 40 to 50% Nifty allocation with 30 to 40% in gold and the remainder in fixed income may be more appropriate. Tactical adjustments can be made based on macro triggers. Increase gold exposure if inflation reaccelerates or geopolitical risks spike. Overweight Nifty if earnings growth exceeds 15% and global liquidity improves. Importantly, avoid binary thinking. This is not a winner-takes-all contest. The goal is portfolio resilience, not maximal returns from a single asset. Monitor key indicators monthly. United States Consumer Price Index and Federal Reserve dot plots. Reserve Bank of India policy stance, Nifty earnings revisions, gold exchange-traded fund holdings, and US dollar to Indian rupee trends. Rebalance annually, not emotionally. And remember, time in the market beats timing the market. Whether you choose gold, Nifty, or wisely, a blend of both consistency, discipline, and diversification will matter far more than any single forecast for 2025. If this breakdown helped you see the bigger picture, make sure to like this video, subscribe to the channel for more data-driven investment analysis, and drop a comment below telling us how you are positioning your portfolio for 2025. Are you Team Gold, Team Nifty, or playing both sides? We read every comment and appreciate your engagement. See you in the next video.